Kenwood Center represents 7% of our total portfolio, and the fund is mandated for a 3 to 5 year hold period with targeted returns over 9% per year. Our sponsor is MacArthur Properties, who is a fully integrated real estate company that's headquartered in Kenwood. They have developed and managed over 4 million square feet of space in the Kenwood market, and they developed this specific property. Now on to the Kenwood Center. The Kenwood Center is a 341,000 square foot Class A power center located in the Barrington Valley submarket of Kenwood. It is currently 75% leased, and it is shadow anchored by a 120,000 square foot super target. Additionally, there are strong economic drivers in the region, which we will discuss later. There have been some systematic changes in the retail industry which have negatively affected Kenwood Center. Occupancy is down by 18% right now, led by the vacancy of big box retailer Gander Mountain. Additionally, due to Toys R Us's bankruptcy proceedings, they're requesting for the rent to be reduced to $7 per square foot. Due to these developments, MacArthur is not generating sufficient cash flow to meet their debt obligations, and without extension or modification of the loan, they will default on the property. We do, however, believe that there are many positives to this property. For one, our sponsor in the deal, MacArthur Properties, is a local, experienced operator who has had success in the region. Additionally, there are strong sales of over $260 per square foot and is located in a top 20 MSA. Also, household income is over $56,000 within a 3-mile radius, and there's strong population growth that is expected to continue. Also, there's a strong and diverse tenant profile, which we'll touch on later. However, there are some negatives with this property. The first is that it is our first deal with MacArthur. Additionally, upon closure of our loan and the senior loan, MacArthur cashed out 80% of their equity in the deal, and the space is only 75% occupied, including a vacancy of big box retailer Gander Mountain, which is an especially difficult space to fill in this current environment. On this next slide, we've listed our 5 healthiest tenants in the shopping center. All of these tenants have strong year-over-year earnings growth and strong current ratios, which makes us believe that they're going to continue to be strong tenants for us going forward. On this next slide, we've listed 5 of our financially stressed tenants. The one that I'd like to pay particular attention to is Toys R Us and their recent Chapter 11 bankruptcy proceedings. We recommend that MacArthur agrees to their request to lower their rent to $7 per square foot, because right now the shopping center is only 75% occupied, and 15% of the current tenants have co-tenancy clauses and will vacate the property if Toys R Us leaves. I'm now going to turn it over to Nick, who's going to talk about the current state of the retail market.
It should come as no surprise to anybody that the retail market is changing. This has always been an evolving industry. From small town stores to local city centers, to major department stores, to nationwide boxes. In 1980, Walmart had just over 300 stores nationwide. Over the next 25 years, that number would balloon to over 5,000, and today it's closer to 11,000. In 1995, Walmart was the gorilla in every room. It was the death of the U.S. industry, the U.S. retail industry. Today, we have a new gorilla in the room. E-commerce, and Amazon specifically, is killing the traditional retail industry. Store foreclosures are sweeping the nation. We have a retail apocalypse on our hand. It's our view, however, that while the industry is changing, perhaps more quickly than ever, there is a future in retail, and those who are willing to adapt and evolve are going to be able to succeed. And we can't touch on the future without talking about everybody's favorite subject, millennials. There are about 80 million millennials approaching prime spending years. They value convenience and experience above all else and operate on their smartphones, which is becoming the main touch point for major retailers who are succeeding. For those that aren't adapting to this change, they're falling behind. You see in the headlines that there's been several store foreclosures for major discounters across the country. What we haven't seen is the major store openings in fast food restaurants, fast casual restaurants, and mass merchandisers. A recent study by IHL of more than 1,000 brands across the country showed that 751 brands are still opening stores while only 280 are closing. And the advent of e-commerce, the introduction of millennials is only part of the story. We're seeing more and more traditional e-commerce players coming back into the brick and mortar space. Amazon now operates 15 bookstores nationwide. Companies like Bonobos and Nantucket are opening showrooms that allow customers to come into their showroom and test their product. The key is that these companies are successfully marketing to retailers online while bringing them on location. In summary, we believe that retail is not dead. It's evolving, and it's evolving quickly. But it's important to remember that people of all ages, especially millennials, still crave an experience in a physical location. 9 out of 10 9 of the top 10 retailers are physical chains at this moment. Yes, there's a shift happening, but this idea of the sudden apocalypse or the end of retail, in our opinion, is simply incorrect. And it's through this macroeconomic lens that we are looking at the Kenwood investment.
So on the negative side, we do know that big box retailers are closing, as can be seen with Gander Mountain's recent vacancy at Kenwood Center. However, on the other hand, discount stores are thriving. Our tenant, Home Goods, is owned by TJX Companies, whose sales increased by 7% from 2015 to 2016. In addition, consumers are still shopping at stores that provide them with a unique experience, such as our tenant Ulta, whose same-store sales rose 14.3% during the first quarter of 2017. Also, cell phone service stores are continuing to grow. T-Mobile recently announced that they are opening 1,000 new stores by the year 2020. This is great for the stability of Kenwood Center, which has both an AT&T and a T-Mobile. And finally, fast casual restaurants are rapidly expanding and are expected to grow by 7% during the year 2017. Kenwood Center benefits from fast casual restaurants such as Chipotle and Jason's Deli. Now, Kenwood Center is a power center, and as a power center, that means that Kenwood Center and us as the lender are exposed to these changing times and the closing big box retailers. However, we believe that power centers can still be a profitable investment as long as the property is able to adapt to the evolving retail industry and focus on service and experience-oriented tenants. Now, moving on to the financial analysis of Kenwood Center, I'd first like to walk you through the sources and uses of this deal. Now, when this current bridge loan closed in 2015, it included a $40 million senior term loan, which was financed by Jamestown Bank, as well as our $20 million mezzanine loan. These loans were used to refinance the original construction loan, to allow MacArthur to buy out their equity partner, and to provide MacArthur an 80% return of their original equity contribution. Now, with this new modification, the senior term loan will decrease to $38 million, and our mezzanine loan will increase up to $26 million. Of this additional $6 million, $2 million will be used for capital expenditures, and $4 million will be used for TIs and LCs. Now, to refresh your memory on the terms of the current loans, both our senior and our mezzanine loan will mature in 7 months. They are both interest-only loans. However, the senior loan will begin amortization in January of next year. They are both non-recourse loans, and our mezzanine loan includes a pledge of the borrower's equity interest in the property. However, given the current decreased cash flows and occupancies at Kenwood Center, it is likely that the borrower will not meet its required debt yield extension tests of 12.75 on the senior loan and 8.5% on the mezzanine loan. And Andrew will now walk you through our options moving forward.
While we are proposing to modify the existing loan with MacArthur, we are faced with 3 alternative options. The first option we will discuss is foreclosure and sale. In this option, we are rejecting MacArthur's modification offer. Assuming they default on the loan, we will pursue immediate sale of the asset with the senior lender with the hopes of selling by March of 2018. The main rationale behind selecting this option would be to avoid adding additional capital to a potentially sunk deal. The primary fallback of this option is that we are guaranteeing returns, or essentially guaranteeing returns that are below the target of our fund. As you can see from the sensitivity table below, our returns are very dependent on the market valuation of the property. If the value of the property were really worth more than $60 million, the value of the loans at the moment, then it is likely that MacArthur would pursue a sale of the asset themselves and pay back the loans, which makes it more likely that the property is underwater. The second strategy we will go through, instead of foreclosure and sale, is foreclosure and lease up of the property ourselves, taking over MacArthur's equity interest. One major concern with this deal for us is the additional capital required from Oakwood. The senior lender is requesting a principal paydown by sizing the loan to a 9% debt yield, which will result in a payment of $3.1 million. In addition, we would be forced to cover up to $6 million in TIs, leasing commissions, and deferred maintenance costs as we hold the property. Despite these significant costs, the most important question may be, do we want to control the asset? As Rick discussed earlier, MacArthur is a very reputable operator in the area. Effectively managing and leasing a property is very difficult, especially with no experience. Consequently, we are assuming it will take us 4 years to lease up the property if we take control. At a 7% cap rate, we believe we could boost the value of the property to over $71 million, which would result in an IRR of 14.1% on our total investment and close to 80% on our additional investment post-December 2017. While these projected returns are very intriguing, we have to ask ourselves the question, is this proposal in line with the strategy of our fund? Are we comfortable with letting our operational performance dictate the returns of our investment? If we remain at 25% vacancy, our return on over $26 million would be around -5%. It is Oakwood's job to achieve returns over 9% by selecting operating partners to execute a business plan that meets our criteria, not to operate the property ourselves. I'll let Juan explain our more preferred scenarios in more detail.
So, onto the third part of the decision tree, let's start by summarizing the proposal. So, the client is requesting us a 30-month extension on both loans, changing the maturity to December 2020. He's also asking for an extra $6 million for TIs and leasing commissions and a 4% accurate feature on our entire loan. In exchange, he's willing to make a down payment of $2 million on the senior loan. So what we like and don't like about this proposal? On one hand, we are very comfortable that the senior lender is willing to change its loan to an interest only, which is a positive indicator given that they have a stronger relationship with the client than we do. In addition, the sponsor's willingness to add money to execute the transactions shows us that he is very committed into the deal. And finally, the proposal gives MacArthur the necessary terms to avoid a default. On the other hand, the extra $6 million exposes us to a riskier deal without the corresponding return. So we are not very comfortable with the 4% accurate structure at the same interest rate, even if we assume a restructuring fee of 75 basis points. But to better understand the proposal, let's look at how the asset is performing. As you can see in the graph, now Kenwood Center has a 28% economic vacancy and a monthly NOI of $280,000 or $3.4 million a year, with huge room for improvement. Being conservatives and considering a moderate lease-up strategy, we believe that the asset can reach stabilization in 36 months, when the monthly NOI will reach $400,000 or $5 million at December 2020. All of this assuming a 7% economic vacancy, the market's average. But those numbers can be achieved without the additional capital for TIs and leasing commissions. So in the current situation of a $3.4 million NOI, the asset can be sold for $57 million, assuming a 6% cap rate. On that situation, as the mezz lenders, we only recover 17 out of the 20 million initially borrowed. With our help, the client's business plan can add value for more than 18 million at December 2020, when the NOI will reach 5.3 million and the asset can be sold for 75 million at a 7% exit cap rate. So under our assumptions, the exit cap rate must exceed 8% to start not getting fully repaid, and a scenario that we believe is very unlikely. So overall, we think that this is a reasonable proposal, but it can be improved, and Ben is going to show you how.
Now, after coming to the conclusion that MacArthur's proposal was good but not great, we believe that in order to achieve the best outcome for Oakwood, we would need to submit a modified proposal altering the loan pricing and adding further collateral. And after analyzing the cash flows, we decided to accept the new pricing of LIBOR plus 4 with 4% accruing on the original $20 million loan. But we did include a step up on the interest, which we will discuss in more detail shortly. For the new $6 million loan, due to the added risk from the investment, the original pricing of LIBOR plus 8 no longer applies, and we will be increasing the interest rate to LIBOR plus 10 with no accrual. Finally, we are going to propose that MacArthur include the 12 parcels valued at $5 million as collateral in order for this deal to go through. Now, while there are many reasons we're excited about this opportunity, there are a few issues that we want to highlight. The first issue is the accrued interest rate. While this is not our typical structure, we are projecting that by mid-2019, the company will be generating consistent and strong cash flows, and we will be able to convert the pricing on the original loan back to a LIBOR plus 8. The second issue is that the additional $6 million loan will increase our total debt amount on this investment. While this may not be ideal, we actually view this as an opportunity to increase not only our returns, but receive a higher IRR. And the third and final issue is that there's no guarantee MacArthur will accept this proposal. While there's no way we can predict how they will react, we feel very strongly that they will view this proposal as extremely fair and one that will result in a win for all parties. Now, as you can see on the graph, with the addition of the $6 million loan, the property would currently be operating at a less than 1 debt service coverage ratio. That is why we're comfortable allowing 4% to accrue on the original loan to provide MacArthur with some flexibility to make the necessary adjustments. And through our lease-up strategy and our projections, we estimate that the property would be operating above a 1.05 service coverage ratio by mid-2019. And after 3 consecutive quarters at or above a 1.05 ratio, we would then convert the loan pricing on the original loan back to a fully payable LIBOR plus 8, further de-risking our investment. Now, several changes occur because of our modification, including total debt yield increasing by 20 basis points, and the sponsor actually receiving a higher multiple on money, albeit with a lower IRR. Oakwood's IRR, while it is misstated on this page, would be 10.4% at the projected exit cap rate of 7%, which would be a great return on this investment. And that IRR would only decrease in the unlikely scenario that cap rates rise above 8%, which we're confident will not be the case. Finally, we wanted to survey the market to ensure that a potential buyer existed, and our research showed us some interesting facts. But most importantly, we found that REITs are the largest owners and operators of some of the largest U.S. shopping malls and centers, and we believe that they would be the most likely buyer in the scenario of a sale. And finally, as we discussed earlier, we believe that the power center market is actually performing quite nicely. In fact, in 2016, power centers were the only retail segment with year-over-year growth in deal volume. That is why we are recommending that we work with MacArthur to restructure the deal, but include our proposed pricing strategy and add the parcels as collateral. This deal will keep MacArthur incentivized to perform as they maintain equity in the asset and will provide Oakwood with higher returns with less risk. We believe that this property is more than capable of making a strong turnaround that will result in a successful and profitable outcome for Oakwood. Now we'll discuss our recommendations for future investments.
For reasons already discussed in this presentation, we see no reason to discontinue lending against retail properties that meet certain criteria. We want to focus on top 20 MSAs with market vacancy less than 7%. And we would ideally target neighborhood centers anchored by grocery stores or gyms, which over the past several years have been more resistant to changes in the retail industry. Despite that, we will not avoid all other types of retail. While vacancies of traditional big box retailers have been filling the news feeds, other segments are growing rapidly, such as fast foods, bars, restaurants, and mass merchandisers. For this reason, and as long as the investments meet our 6 criteria, we are confident that we will be able to achieve returns over 9% going forward on investments similar to the Kenwood Center. Thank you, and we're open for questions.
The O plus 10 on the new money, it said no accrual, so that is being paid on a current basis?
Yes.
There's enough capital for that, and then you're accruing the 4,
Yes.
and you're going to capture that once the total stack, including the O plus 10, is at 105?
Correct. And yeah.
Do you have a backup plan if the sponsor doesn't allow the additional collateral to be brought into
So we did. We felt that the operator, they had developed 4 million square feet in the area or managed or leased, and they seemed very respectable, and we really would not like to take over the property. So we were willing to, if they don't want to have the collateral, we'd still want to make a deal with them, and even to the point where we would probably accept their terms, but we would also probably look for other third-party operators to see if there's someone that could maybe take their place if they don't accept their terms, but ideally we would have them operate the property.
How did you evaluate taking the out parcels
Yeah, I mean, we ran the analysis. The incentive for the equity returns are, there's incentive there for them to work through the deal. They only have to put $2 million down, and the returns are, they get $13 million back at the end of the deal if they're successful, and there's plenty of upside there. We thought the $5 million was, I don't know, more, it's a safer investment for us. It's less dependent on how they perform, but it's got similar.
And at the end of the day, we're a debt fund. So we want to make sure that we eliminate as much risk as possible. And by adding these parcels, it gives us some assurance that if for some reason we weren't able to lease up in the right strategy, we have something to fall back on.
Do you have an opinion as to what kind of tenant you would like to see in the 52,000 square foot vacancy?
Yes, so some of the tenants we thought would be good potential tenants for that 52,000 square foot would be a gym such as LA Fitness or another large gym, which typically takes up spaces that are about 50,000 square feet. We thought that would be a good draw for the center. Or perhaps in a grocery store, such as an organic grocery store like Sprouts or Trader Joe's. Given that there's no other grocery store within that center, we think that would be a great addition as well. And they're also expanding at the moment, so they're healthy tenants.
The IRR of 79%, what was that exactly?
That was for our $6 million, up to $6 million post December 2017. So just the capital from there forward.
Thank you.
Thank you.
Thank you, guys.
Thank you.